Hi, everyone, and welcome to today's Strategy Skills podcast. And we have a very special guest today. For those of you who follow the world of corporate finance and corporate strategy, you would know the name Tim Koller. I think it's not an exaggeration to say that he's probably the most influential person in corporate finance in the world. His thinking is used around the world by just about every single major company or major business schools. He is the lead of Valuation, which is probably in its 7th or 8th edition by McKinsey. He also leads McKinsey's Strategy and Trend Analysis Center, which is basically a research hub that looks for opportunities and patterns for companies to unlock shareholder value. And he also founded, for lack of a better word, McKinsey on Finance, which is almost a quarterly spin-off of the McKinsey Quarterly, focused purely on finance. Now, in this discussion, which I enjoyed thoroughly, and I think Tim did as well, we have a wide-ranging dialogue on corporate finance. And it's a discussion about corporate finance strategy as opposed to the mechanics of corporate finance. Because, the best way to think of this is a company is like a car. It needs fuel. If it doesn't have gas loaded in at regular intervals, assuming it's gas-powered and not electric, it's going to stop working. You're just going to have a very expensive piece of gleaming metal with lots of original equipment from German suppliers, and that's about it. A company is the same. It needs capital. But just knowing the cost of your gas and how much gas you have is not enough to make the car perform at its optimal level. You've got to figure out how to make the best use of that gas, how to make the car efficient, how to remove impurities. A company is the same way. Just knowing how much your capital is worth, what the return is, and how much is being destroyed or created is basically the basic building blocks of corporate finance. So we talk about how companies should deploy that capital, how they should govern that capital. So I enjoyed the discussion immensely, and I hope you will as well. Welcome, Tim.
Hi, Michael. Thank you so much for having me.
It's my absolute pleasure. How are you this morning?
I'm doing well, thank you.
Okay, so it's quite a turbulent time, right? I mean, lots of things happening with the virus, Brexit, pending recession, maybe the worst since the 1940s. I think a good place to start is just to maybe give the audience some ideas on how companies should be thinking about preserving and maximizing shareholder value in a time when they're just barely able to survive.
Yeah, so when you think about the question about how companies should be preserving and maximizing value, I think it's important first to separate companies into different categories because the actions that they need to take are different. So, for example, on the one hand, you've got companies that are, as you pointed out, struggling for survival, right? On the other hand, you've got companies that, are still operating very strong. They're not seriously affected by this, and they have very strong balance sheets going in. And then you've got some companies in the middle which are doing okay and likely will. So I think that the actions that companies need to take really depends on which category they are in. For example, certain retailers, are barely surviving, and probably some of them will go bankrupt. Right?
Yes.
On the other hand, some of the tech companies and some of the pharmaceutical companies and stuff like that are doing just fine. Right?
Yeah.
So if you're a company that is fighting for survival, basically that's what you have to focus on, right? How do I maximize? What can I do to generate cash in order to be able to survive for however many months it takes before the business can start turning around again, right? And that may include focusing on obviously working capital, and as well, cutting any unnecessary costs, and ideally prioritizing the cost cutting so that you're only cutting things that aren't going to damage you later on. But you may have to go a little bit farther than that. But so survival is the key for those companies. The companies on the other extreme sort of have to view this from a through cycle perspective, right? And they have to be focusing probably a little bit more on the longer term and how can they position themselves to come out of this in a strong or even stronger competitive position. And what can they do to take advantage of the situation, right? So they should continue to invest in product development, for example. They should continue to invest in talent, maybe use
Yes.
this as an opportunity to acquire talent, those kind of
Yeah.
things. So they have a very different sort of approach here, and they should be taking advantage of this opportunity. Companies in the middle, sort of depends. Ideally, they would do things so that they could also act more long-term oriented, but conserving cash on things like maybe dividends. So they might be the ones who cut their dividend so that they can continue to have a longer-term strategic perspective and invest for the longer term. So it really depends on where you stand on the spectrum as to sort of what you should be doing and what your priorities should be.
And I think the challenge here is that if you're a CFO or CEO and you're reading the media, Financial Times, Wall Street Journal, New York Times, and so on, a lot of the focus is on the crisis and the trauma at the moment. And it's easy to assume that's all you have to focus on. But what you're saying is that as a CFO, as a CEO, you have to really identify the type of company you are and try to separate yourself from the noise and come up with a bespoke strategy that's going to be the one that is best for you, as opposed to what the media is saying is the focus at the moment.
Yes. Yeah. Two things there. One is, you're absolutely right. You need to focus on what is best for you. There is no generic strategy that fits every company. Secondly, we think also that you have to be thinking about this in two time frames, and maybe even having two separate teams focusing on these.
That's interesting.
One of which is, most people are going to be focusing on what am I doing right now for the next couple of months to get through this period, right? Another idea, though, is to set up a separate team that is focusing on how do we come out of this, and so how do we best prepare to come out? What are the actions we're going to take as the economy begins to stabilize and turn up, so that we haven't sort of forgot about that, if you will, right? Because as you pointed out, it's easy for everyone just to have it on all hands on deck.
Yeah.
But you should take some senior executives and say, okay, your job is to figure out, given different scenarios that might happen, what are the things that we should be doing, and when that does happen, so that you can move quickly to take advantage of the upturn, and you already know what you're going to do as things begin to turn around. So it's important to have both lenses, and often takes different people, to focus. Obviously, the CEO and CFO have to have an eye on both, but it is useful to have this other team looking forward, planning ahead to what to be ready for this thing to come around. Because one of the unique things about this situation is that we don't know how quickly the recovery will be, right? And there's lots of different scenarios out there, and you need to be prepared for different types of recoveries.
Yeah, this is interesting. So it's almost as if you've got a red team to survive and preserve cash, and you've got a blue team to say, what do we do when things stabilize and the uptick begins? How do we prepare and exploit that? So if you based on your experience, right, you've seen how CEOs, CFOs, and the chief operating officer have to work together to manage a war room in this time. What would you say are the best practices for how management teams should, I think, keep that focus on the short term, but not ignore the medium to long term when things recover?
I think part of it is having this may sound obvious or trite, but having a fairly systematic schedule, if you will.
Okay.
So, for example, a lot of when you do what, right?
Yes.
So a lot of companies, that we've worked with, have daily meetings, not necessarily with the CEO, but to monitor and to, test or to examine ideas for cash preservation right now, right? And those ideas, would be reviewed maybe say weekly by the CEO and the CFO. So you need to have a regular rhythm so the CEO can make decisions quickly, or the CEO, CFO together can make decisions quickly about, what costs to take down, or how much, or how aggressive to be with your suppliers or customers, those kinds of questions, right? So you need to almost have it. The CEO, the difference here is the CEO needs to have their hands dirty and much closer to the details often than they often are. And at the same time, but you can do the same approach, but maybe not with such urgency, is to sort of allocate, 3 hours every 2 weeks or something for the team that's planning ahead.
Yes.
Right, where the CEO and CFO spend time with them. You have to have that kind of disciplined schedule on a regular basis, so that you're looking at, CEO has to be looking at both.
Yeah.
So the best way to do that is to have a schedule for them. And the team that's planning ahead should also be, doing this in a systematic way, starting with, okay, what's our current situation? What are the scenarios that may play out that will affect us, and how should we move forward given that?
And do you find that level of routinizing the meetings would apply to board updates as well?
Absolutely. The board obviously is not going to go into as much detail as the CEO and the CFO, and they don't have as much time, but it is important for them to be kept informed of all the important decisions and the progress that the companies are making, right? So, instead of meeting once a month or once every 2 months, it's not unusual for the board or certain members of the board to be meeting, with the CEO or talking to the CFO on a weekly basis or biweekly basis kind of thing, depending upon the nature of the company. Obviously, if you're struggling for survival, it maybe is weekly. And if you're a little stronger company, maybe you don't have to do it as frequently. But the board has to be involved and know what's going on and asking. But what's also important is that there has to be transparency for the board, so there's no surprises.
Yeah.
And secondly, the board has to, be asking, really engaged and asking the tough questions. So this is going to be very taxing for a lot of boards of directors because they're not used to operating this way, particularly if you're CFO of another company and you've got your own issues to deal with, right? So this will be a good test for boards and how well they can step up to help the companies that they work with, given their limited time as well.
Yeah, I don't think it's going to be easy for someone serving on 20 boards. He's going to have a hard time, this person.
No, or even 2 boards with a full-time job, right? So, in some ways, the best position to help will be people who are recently retired, let's say, and only have a couple of boards, but have a tremendous amount of experience. Those are, you have to sort of probably rely on the board members who can really add the most value, who've been through things like this, but also have the time to put in to understand what's really going on inside your company.
So I suppose one of the byproducts of this traumatic system or what's happening in the economy is maybe there'll be a renewed focus on how to structure boards that can be more effective.
That would actually be a good thing in general. One of the things that one of my colleagues a number of years ago did an interesting piece of research where he looked at how much time board members spent who were board members of publicly traded companies versus those which were private equity held, and what they spend that time on. And this were people who were on both boards, right?
Yes.
Both types of boards, right? And he found that if you were on the board of a private equity held company, you were expected to spend 2 to 3 times as much time as a board member. And much more of that time was spent on strategy and performance management and not on legal and regulatory things. So, and the boards, typically are expected to add a lot more value in those kind of situations. So this is an opportunity, I think, if we find that some board members just aren't able to make contributions, given their other commitments, it could be a good catalyst to strengthen the boards, have them put more time into things, maybe set up, many boards don't have like a strategy committee, right? Set up a strategy committee that's much, maybe they spend a lot, maybe not every board member can spend a lot of time, but maybe some board members spend twice as much time and really dig into the strategy and the performance of the company and then report back to the other board members. Or maybe board members specialize in different business units. You need something to get the boards to understand things at a more granular level. And you also need to get boards to ask the harder questions, not only when things are going poorly, but when things are going well, you really want to understand why they're going well.
Yes.
And because sometimes they're going well for the wrong reasons, right? So this is a great opportunity for, among other things, for the role of the board and the way boards operate to be improved as we come out of this.
So it's a stress test for the company's balance sheet and the company's governance model.
Absolutely, absolutely.
And one of the things I've seen in my time, when you look at emerging markets, for example, because there is on average a smaller pool of highly educated and highly trained business people, you tend to find one person serving on multiple boards.
Mm-hmm.
And
Yes.
I think it'll also cause some kind of shakeout in emerging markets, whereby a lot of companies are going to be put under pressure. And can people who are serving on something like 10 or 12 boards really give the time that is required?
Yes. I mean, and for example, in the U.S., people have already moved away from that, right?
Yeah.
And investors, clearly disapprove of having board members who serve on too many boards, right? That's already
Yes.
happened in the U.S., and so you
Yeah.
already don't see it. So it's only a matter of time before that happens in emerging markets as well. One of the things you find in emerging markets is sometimes hiring or bringing on board members from the U.S. or Europe,
Yeah.
who have because many of these emerging market companies have global aspirations anyway, so
Yes.
they need to have people who understand
Yeah.
the rest of how the rest of the world operates. Smaller boards who are spending more time, for example. So you're right. There is a lot of opportunities. Also, it also depends on whether the founder is still involved or not.
Yes. Yes.
Oftentimes, if the founder is still involved, what's interesting is that board governance probably isn't as critical because the founders usually are much longer term oriented. They've built the business, they understand it. They don't need a very large board helping them, right? On the other hand, if you're 3 or 4 generations down the road, and the founders, and the founder's son or daughter is no longer involved, that's when you need a stronger board. State-owned enterprises in particular also, which you have a lot of in emerging markets, or somehow where the government is involved, also need stronger boards, and often boards which have less government representation and more business people on those boards.
Yeah, that's right. Also, if you think about family-owned conglomerates in emerging markets, they suffer from the similar problems. At a certain point, the sort of iron grip of the founder disappears, and you need to bring in external professional managers at the board level and executive level. So let's just shift focus a little bit and talk about some of the decisions the board and executive team has to make. And I think one of the toughest decisions, which is hard for any company, is distinguishing between decisions that are good for the performance now to survive, but are not going to hurt the health of the business in the medium to long term. So in your experience, what are the ways managers need to categorize decisions? How do they know they're doing something that's going to help them today, but not jeopardize what they need to do 6, 12, 24 months down the line?
The way I think about it is to think about it from the lens of the customer.
Yeah.
If you're cutting a cost that the customer is going to notice, right, you better be cautious, right? So if you're cutting
that's
costs,
a nice way of thinking about it.
Yeah, if you're cutting costs in the distribution system and making it more efficient, that's great.
Yeah.
If you're cutting costs in the back office, that's great, right? If you're doing something where the to save money on the product, that's not purely efficient. If you're doing things so that the factory, has less downtime, that's a no-brainer. You do that, right? On the other hand, if you start to substitute different materials, or make the product less, reduce the quality of the product, it's rare that the customers don't notice that.
Yes.
Right. And so that's the lens. If you are, if you're a retailer and you reduce customer service, for example. So customer service and the quality of the product are the things that should be inviolable whereas as you make these trade-offs between sort of short-term performance and health. And similarly, product development is absolutely essential because if you're not doing it, someone else is. Right?
Yes.
And unfortunately, if you look around in many industries, much of the innovation has come from, small startup companies.
Yeah.
Even in industries like consumer packaged goods or consumer packaged foods, and that's put the bigger companies at a disadvantage. So you need to focus on, on the customer in particular. You also have to focus on the employees, right? Employees, the work environment. People don't mind working hard, but they have to sort of see that it's accomplishing something. They're doing something that they like to do. They like the people that they're working with.
Mm-hmm.
They like their managers, etc. So, in addition to focusing on the customers, you also have to make sure that your employees are happy, and that you're not just burdening them with more stuff. Right? Oftentimes, you can cut costs without burdening the employees with more work just by cutting out waste, right? A lot of stuff there's so much waste in companies, so much bureaucracy and extra sort of processes that can cut out that make the employees' life better as well. So if you've got happier employees and you've got, a focus on the customer, that's, I think, a good way to sort of decide whether something is going to be, only improve the short-term performance but damage the health of the company.
Yeah, it reminds me of these American automobile companies in the 80s and 90s when they started sharing parts and the chassis between the high-end models and the low-end models.
Mm-hmm.
And they thought the consumer would never notice. But over time, the consumer noticed, and that's how the German luxury sedans were able to make headway when that gap was created. So this lens is a very nice lens of thinking about a finance decision.
Yes. And if you look at the Japanese car makers, they develop separate brands, but they clearly differentiated in terms of the quality of this product plus the quality of the service experience was very different as well when they brought their luxury brands into the US. So absolutely, you do not want to dilute your, if you're a luxury product, diluting that for short-term benefits. There, plenty of examples of companies in the luxury area that have done things to, they lower the price points, or they come up with other things that attract more customers in the short term because they attract a different customer, but it alienates their core customer, so they end up maybe selling more volume, but at much lower prices and actually making less money.
Yeah. What you're saying is that, if you're a luxury product and you cut costs in something customers will notice and care about, maybe in the short term, you'll make a lot of money because people will buy the stuff, but very quickly they're going to notice they bought something a bit shoddy, and you're going to lose a lot more than sales in the long term.
Exactly.
So that's an example, a very good example of increasing performance in the short term and damaging your health in the medium to long term.
Exactly.
Now, talking about investing in products, taking care of employees, making the right kind of cuts to remove waste and bureaucracy, all wonderful things, and all companies should be doing that. But for the last few years, companies have been obsessed with stock repurchases and protecting dividends. Now, we've seen companies like HSBC that is considering moving their domicile from London to Hong Kong just to protect the dividends to Hong Kong-based investors. And you have companies like Facebook and Apple who kept cash on hand, and obviously now they're going to benefit from that. So there are very few companies that have a regulator telling them or guiding them on how much cash to keep on hand, financial services companies primarily. So if you are in a company, whether the CEO or the board member, how do you go about thinking how much is the right amount of cash to keep on hand? You don't have guidance like a regulator.
Yes, as you pointed out, I think the banks are an exception because the regulator is involved. I think one of the things that's important to realize first of all, if you look in aggregate at the total distributions to shareholders, between dividends and share repurchases as a percentage of income,
Yes.
It hasn't changed that much over the last 50 or 60 years, surprisingly, right? What's changed is the mix between dividends and share repurchases.
Oh, okay.
And so it used to be that companies, pretty much distributed cash only through dividends, and now they distribute it 50-50 on average, on total, I should say,
Yeah.
between dividends and share repurchases. That's one thing that's important to realize, right? Secondly, it's important to realize that the companies that are doing the biggest share repurchases are companies are typically in a fairly small number of industries. They're in the pharmaceutical industry, they're in certain parts of the high-tech world, and medical devices, for example. Those are all industries which are characterized by very high returns on capital.
Yes.
And modest growth. The big, the big tech companies really aren't growing that fast anymore.
Yes.
Okay, relative to, and so these are companies that are generating much more cash than they could ever profitably reinvest back into the business, right?
Yes.
So from an economy-wide perspective, those companies, we do want to be returning cash to shareholders, and they should be returning 90 or 100% of their profits back, because for the most part, by the way, their profits are defined after research and development, right?
Yeah.
Which is what their big investment is. Most of these companies don't have a lot of physical capital, right?
Yes.
So if you think about it, traditionally we talk about, how much cash they're returning relative to, after-tax profits, where you're already subtracting off billions of dollars of R&D investment that they're making. So I think that some of the criticism is misguided because it really doesn't look at a granular enough level and saying which companies are really doing the repurchases or returning so much cash. And what's happened over time, particularly in the U.S. and much less so in Europe, is that the structure of large companies has changed, where it used to be, well distributed across industries, and now you have a situation where tech, pharmaceuticals, medical devices account for maybe a third or more of the total profits of U.S.-based companies.
Yes.
Now, that doesn't mean they earn all the profits in the U.S., but they're U.S.-based companies. They're generating all this cash flow. And so they should be returning a lot of cash to shareholders, because they're often, their growth has slowed. They're growing less than their revenues, less than 10% a year, maybe less than 5% a year. And there's a mathematical formula, as a matter of fact, that that says, the rate at which you're growing and your return on capital determines how much excess cash flow you'll be generating.
Yes.
And that has nowhere to go. And you don't want people to invest capital just because they have it.
Well, they'll destroy capital.
You only, they'll destroy value because they run out of opportunities.
Yeah.
So you do want them to return that to shareholders. So I think some of the, you need to, dig deeper and really think about who is returning capital and why they're doing it. And for many companies, they're doing it simply because they don't have any place to. It's not that they're passing up investment opportunities. They just don't have enough ideas or enough people to pursue investments that would absorb all of that capital. So I rarely see companies that are repurchasing or distributing cash in terms of dividend share purchases at the expense of investments. That happens once in a while, but it is rare. And if you look at the total investments in terms of capital expenditures, in terms of intellectual property type of investments in aggregate for the economy as a whole, they haven't slowed down any. So it really hasn't affected the total amount of investment in the economy.
So leaving investments aside, is there a case to be made that more cash should be kept on hand for these kind of black swan events like a virus?
That's great. I absolutely believe that, yes, there should be. Because they may appear to be black swan, but they come every 10 years or so.
That's true.
Not,
it's a very rare, it's a very frequent occurring black swan.
Right. And so, when we went into the financial crisis in 2008, 2009, we were very lucky that most large non-financial companies
Mm-hmm.
went in with very strong balance sheets,
Yeah.
right? And that enabled us to, there really weren't very many bankruptcies or financial distress in industries other than the financial world, if you
Yeah.
will. The stress was in the financial world, consumers and debt, and governments is where all the debt was, right?
Yeah.
And similarly, right now, the companies are best positioned, and there's been academic work, and this tiny little extra benefit you get from maybe having more leverage from a theoretical perspective
Yeah.
is swamped by the risk of not having enough of a cushion or enough
Yes.
capital to get through the tough
Yeah.
times. So we believe, and we typically recommend that, if companies of a certain size should have a very strong investment grade rating, right? Meaning, high triple B or a single A rating, because that gives you an opportunity to get through a tough time, right?
Yeah.
And that's more important than sort of trying to get a little bit of extra tax benefit from the debt,
Yes.
from having more debt or having more leverage kind of thing. Because, you never hear about companies who were under-levered sort of, as being a cause of a big problem, but you often hear about companies that are over-levered, running into problems. Even if their business model is okay, one shock hits them and
Yes.
the debt comes due at the same time and they're in trouble, right? So it makes, and many CFOs are already conservative anyway, but it does make sense for companies to be conservative in their capital structures. And what we advise companies to do, and this is before the crisis,
Yeah.
is to do stress testing.
Mm-hmm.
Not just banks, but any kind of company should be stress testing, different economic scenarios, different things that can happen to their industry, different things that can happen to the company, to make sure that they have the capital to get through a stressful period. That's absolutely essential in determining how much debt and cash you should hold.
So just to recap.
And by the way, another thing, just by the way, also by having a stronger balance sheet, if there is a stress in your industry and you have a stronger balance sheet, you are in a better position than your competitors who may not be, to take
Yes.
advantage of that situation, right? To make investments at the bottom of the cycle, perhaps, if it's a cycle specific to your industry, for example. So there are some real advantages to having a strong balance sheet, as long as you convince investors that you're not going to waste that money
Yes.
on value-destroying investments.
So a fortress balance sheet, assuming you're not going to waste the capital, should outweigh the benefits of extra debt, lower cost of capital, and so on.
Absolutely. The only reason, and when we talk to investors, sophisticated investors, or even activists, right, they're only uncomfortable with companies that have fortress balance sheets if they think the companies are going to, the money's going to burn a hole in their pocket and they're going to spend it unwisely on value-destroying investments. So, you want to have a strong balance sheet, but you also have to simultaneously convince investors that you're disciplined and you're not going to make bad investments because you have a strong balance sheet.
So if you're a CEO or CFO, the discussion you want to have with your investors is, we've got a strong balance sheet, but this is our plan for the return on invested capital. It's not just we have a strong balance sheet, but we're not really clear how we're going to deploy this. And maybe we'll go into a totally different industry because we don't see any opportunities yet. It's really about those returns and protecting that return.
And it's about, there's no reason why you can't tell investors in general what kind of returns you expect.
Yeah.
And you say, we're not going to make investments unless we can earn, a 12% return or a 15% return, depending upon the circumstances, right? And being pretty transparent about that, and particularly when you make large investments, reinforcing, you don't need to, if you make an acquisition, you don't need to tell the world what the return on capital is going to be, but you need to explain it in such a way that investors, you have the credibility that, yes, this is going to earn an attractive return on capital.
So let's
and it's amazing how often that the issue of return on capital now comes up
Yeah.
when we talk to investors.
Yeah. So this is a good conversation because you're communicating with your investors, but not all investors are the same. You've got to segment your investors the same way you, as you mentioned, segmented companies and so on, right? So if you're talking to your investors and you've got to come up with some kind of investor relations strategy and plan, how do you go about doing that? I mean, how do you figure out who are your key investors? What are they looking for? Who's long-term? Who's short-term? Who's institutional? How do you craft the message for them? Different stakeholders, different needs.
Yeah. Well, first off, you really do have to have the same message. So you have to pick, because investors will know if you're saying different things to different people. So that just doesn't work. So you have to pick who are the investors that you want to, communicate on. Our research suggests that, there are primarily two segments of institutional investors who matter. One are what we would call short-term traders, and the other we would call long-term intrinsic investors. And our research suggests that the short-term traders tend to influence the volatility in the near term because they're looking for short-term events. But over a period of years, it's the long-term intrinsic investors who are very sophisticated, do a lot of research before they make an investment. They'll hold on to a company for years. They're the ones who really matter. So our advice is to focus on your message on those long-term investors. Craft your communications based on what those investors are looking for. And the challenge is that those investors aren't as aggressive at sort of calling up and reaching out and always wanting news. The short-term investors need news every couple of weeks in order to do their trading.
They're the guys checking their Twitter feed every day.
Right, and they're the guys who, or calling up the CFO constantly or whatever. In some ways, you need a gatekeeper. You need the IR person, the head of IR, investor relations, protect the CEO and the CFO, so the CEO and CFO can be proactive and spend their time with those intrinsic investors who really matter over time. And the IR person should, take care of the other investors, the short-term investors in particular. And it takes some discipline.
Yes.
But it's interesting because, first of all, it's not at all hard to figure out who they are, because investors have to file, and institutional investors have to file with the SEC what their portfolios look like. Yeah. So you can calculate their turnover, so what their average holding period is. You can see how many stocks they have in their portfolio, and things like that. So it's very easy to separate out these long-term intrinsic investors from others. And investors or executives tell me all the time that the conversations that they have with them are just entirely different and much more satisfying with these long-term intrinsic investors. So that I think is the strategy. Segment the investors, push your energies into the long-term intrinsic investors. And they're also the ones, by the way, who are focused on, we're going back to the performance versus health, right?
Yes.
That you were talking about earlier. They're the ones who are more concerned about the health rather than just the short-term performance. They don't expect perfection. If everything goes right, they're going to be skeptical.
Yes.
That never happens, right? They're not so worried about, meeting the earnings consensus every quarter. And in fact, if you're too good at meeting the consensus, they're worried that you're manipulating the earnings, and things like that. So, it's all common sense. But if you talk to those investors, hopefully it gives you the courage to be more longer term oriented in making your decisions and making the trade-offs that you have to make.
And maybe, what you say is very good advice, I think, for business leaders today. Maybe versus listening to the press and getting all excited, maybe this is a moment to talk to your long-term investors and understand what they're looking for.
Absolutely. In fact, we just did a round of interviews of long-term investors to find out what they thought companies should be doing right now, and how they should be communicating, right? And some of the stuff that I communicated to you earlier was also based on the input that I received, what I learned from talking to those investors, right? Obviously you have to be liquid, but those investors are telling us, invest through the cycle. Have a long-term view if you can. If you have to cut the dividend, that's fine. Don't try to maintain that dividend just
Yes.
so you can say you have a continuous stream of dividends. If you think you might need the cash because of uncertainty, cut it. They'll understand. They already expect it because they know a lot about your company anyway and what
Yes.
factors it's facing. So they're already going to understand a lot of these things. They don't want guidance necessarily because no one knows what the next quarter,
Exactly.
or the quarter after, or the year is going to look like. So if you are, unless you're one of the few companies that are not severely affected by the situation, which there are some, but not very many, not providing guidance, saying what you don't know is fine. What you should be doing is explaining how the economy is affecting demand for your products, how your supply chain is holding up, right? And also what your plan, begin to think about what your plans are for when things begin to turn around. That's what they want to know. They want a business perspective. They're not worried about the quarterly results right this year because they know it's bad. They know everything's going to be horrible. Don't try to make it look better than it is. They want you to focus so that you're strong coming out of the recovery. For example, one of the things that we think and they think as well is if you're in a strong position, you should be helping your suppliers and your customers because you'll come out better if your suppliers and customers come out better, right? And so if you're in a position to be able to help them, you should do that, even if it hurts you a little bit in the long term, in the short term, in the near term.
So you can almost distinguish between, as you said, investors that trade for the biggest gain in the short term, who make a lot of noise, and then you have the institutional investors who don't make a lot of noise, but those are the ones you got to focus on. So you're almost distinguishing between the ones who are long term. I don't want to use the word more mature in the way they look at it, but that's maybe a good description. But then this brings me back to the discussion we had earlier about how you structure your board and your executive team. Because in the same way you need very mature institutional investors, you need a CEO and management team that has been through this before to understand that, it's bad, but you got to focus on the right things and not just listen to the media, right? You almost need to think about how do you balance your board and your executive team so there's someone mature there that's going to keep you focused.
Yes, I think that's right. I think that maturity is not necessarily just a function of age, though.
No, of course, yes.
I think maturity is a good word if you
judgment maybe is a better word.
In the sense of, that you have good judgment, that you are you're independent thinker, right? You ask the tough questions, and you don't sort of, just rely on what you read in the press or what some bankers or analysts are saying. You really have to think about what's right for what's your company. Really get, try to get as much details of the facts of what's going on as possible, and sort of use, facts and analysis to make your decisions, not sort of the opinions of the press or whatever else is out there. You sort of have to sort of ignore that as much as possible. And because you should know far more about your business than anyone else, right?
Yes.
And what's going to be driving it, what's affecting it right now. And you should use that information to, apply your good judgment. Ideally, you've had experiences with this. Experience can work both ways, though. We've seen that on boards where, sometimes a board member or two, they've had certain experiences and therefore they think, their experience applies everywhere, right?
Yeah.
So you have to have experience, but you also have to be open to the facts and the analysis at the same time. So it's not just about experience and maturity. It's about bringing that together with an open mind about what's going on that's different than some of your past experiences.
Yeah, I mean, the way of thinking about it is that before the crisis, we had a rising tide lifting all boats and some very lucky executive teams who weren't really doing a good job, but they benefited from a booming economy. But now that you've got to really understand your business and the decisions you have to make, you've got to be able to bring judgment, as you say, but you got to analyze the data on the ground and know what you have to do that's good for you. And that's some playbook that has worked in the sector for the last 5 years. Is that a good way of saying it?
That's a great way of saying it. The playbook should be your playbook, not
Yes.
the generic playbook, right? Because every company is a little bit different, and you have to tailor that to your circumstances.
Yeah. So we haven't spoken much about emerging markets economies and companies
Mhm.
in the emerging markets who are seeing investment being pulled out, sucked out, and taken into safer assets like dollars. If you are a company that's expanding in the emerging markets, you need capital. Does any of the advice you've offered change in terms of how they secure that capital, give investors confidence that they are managing things well? I would think not. It's all about communicating and having the right plan.
I think you're right. I think that the challenges and what they should be doing are essentially the same. You may have to, just because of the availability of capital, though, may be less for companies in emerging markets, depending upon how big you are. You may have to be more careful about where you place your bets, right?
Yes.
And you can't place as many as you would like.
Yeah.
But otherwise, you should be doing the same things. I mean, you do have to sort of take into consideration how much capital you have and how much capital you have access to. And in emerging markets, you've got such a wide variety. You've got some young companies that are doing one thing. You've got some older conglomerates. So the situation is a little bit different for each of them. But the lessons, I think, are the same. That once again, if you can invest for the longer term for how we're going to come out of this, that's the best thing to do. And you have to decide how much risk you're willing to take on, given the availability of capital. Because the challenge is often in those markets that the higher growth does require more investment. Right?
Yes.
And so you have to that's a trade-off that you have to make. So you got to really think through and be very, very careful, weigh the potential benefits of the investment versus the risk if you make those decisions wrong. Particularly for smaller companies where each investment decision is important, right?
Yeah.
The advantage that larger companies have is that any individual investment, unless you're a mining company where a mine costs billions of dollars, each investment is relatively small, so that if some of them fail, it doesn't create a catastrophic situation. So once again, it sort of depends on your situation how you play that.
Yeah,
so that would apply to a smaller company in the U.S. or Europe as well that's growing fast, that doesn't have where each investment is critical and you have to make those difficult decisions.
And you've preempted my next question, because we've segmented companies based on where they are in the crisis. But what about companies on the scale of the investment they need to make? You mentioned mining companies that build power stations and so on, who are making decisions that pan out over 10 to 12 years. And upfront costs are in the billions versus a clothing company, which has much more flexibility. So how do they think about the decisions? And I suppose the principles are the same. It's really a function of them managing liabilities more, because I think the liabilities would be a bigger issue.
Yes. The companies that have many smaller investments, right, can afford to take on fairly risky projects.
Yes.
Right? Because if I've got 20 ideas and they're all relatively small, and 8 of them are successful, very successful, and 5 of them are just okay, and the rest of them fail, you'll still probably get a good return.
Yeah.
Right. And so you do have to approach it differently. You have to be willing to take risk. A lot of companies are too risk averse, and we find that the individual executives are sometimes uncomfortable bringing up risky projects, even if they're small, because it'll affect them personally in their career, right? Whereas from a company's perspective, it makes a lot of sense because you've got this portfolio effect. If you are a company, though, where a single investment is in some ways a bet the company type of investment, you do have to have sort of more margins for safety. right?
Yeah.
In terms of, realizing that there's if you're building things, there's a good chance that it's going to take longer and it's going to cost more than you expect, because it almost always does, right? So you got to build that in, right? You have to, its success depends upon commodity prices. You really have to have a pretty good handle on that and think objectively, not just about where they are right now or what the trend is, but what drives them and things like that, so that you can minimize the risk. And you also can do things, some cases, companies, back when the big oil companies, for example, would develop massive fields or
Yes.
build massive offshore platforms, they would share that risk.
Yeah.
By working together, because the risk was so massive, right? So you need to think about things like that. So it really depends on how big an individual project is relative to the company, and then what impact it could have on the company as a whole.
And I think, building on what you said, which is very valuable, is it also depends on how fast the sector changes. For example, if you look at the automotive sector, you've got to make big bets and investment in electric vehicles. And you have to share some of that risk, because you just can't afford to fund it off your own balance sheet. But in the mining sector, for example, it's not really a sector that's evolving at a rapid pace. So just to build on what you're saying, it really comes back to that point you made right at the beginning. You've got to build a strategy that is unique for you, and not just take a playbook and copy it, because you can end up making some very bad decisions.
Right. And we know empirically that, if you're in the commodity chemical business or the mining business, you're much better off investing at the bottom of the cycle, not the top of the cycle. It costs less, labor's less, the contractors are less expensive, plus then, you can ride the price up. But it takes discipline to invest counter-cyclically, right?
Yes.
You have to get the board to buy into it, et cetera, and you have to go against the crowd when everyone else is building when prices are high. And you have to say, no, we're not going to build right now because prices are high. When everybody comes online at the same time, it's going to depress prices. Most of the cyclicality in commodity businesses is often caused by supply, not demand.
Yes.
Right.
Well, we're seeing that
supply
now.
comes on. Yeah, exactly. That's a very good example, right? It's caused by supply. Well, right now we have a little bit, we have a demand issue, but before the current, pandemic crisis,
the supply issues.
It was a supply issue, exactly, and that happens in most commodity industries.
Yeah. So that's quite interesting, because you have to make the bet that you're investing at the bottom or close to the bottom of the cycle if you're in commodities. And you have to have the discipline to go against the grain, galvanize your leadership team. I think you can convince your long-term shareholders, but it's very difficult when everyone is telling you need to do the opposite. You always have to be quite a confident CEO to do it.
Absolutely. And you have to be conserving your cash and capital at the top of the cycle so that you have it at the bottom of the cycle to make those investments or to make acquisitions. And if you look at people, that's Warren Buffett's strategy has always been to be counter to what everyone else is doing, right? And if you look at, success, it's often, from companies or CEOs doing things, off cycle with what everyone else is doing.
Yeah. And as a commodity leader, you got to make sure that you have a pretty good grasp of the fundamentals so you can get a sense of when it's the bottom or the top of the cycle. And not start making big investments when things are about to collapse. Right.
Or at least don't be pro-cyclical. If you can invest, in a steady way, some companies, can invest steadily across the cycle, so they're not predicting the cycle. That's good as well. But too many companies invest at exactly their timing is exactly off.
Yes. And we've seen that right now, right? There are some who've made smart investments, some have made poor investments. And as you say, there are a lot of companies who understand that when asset prices are depressed, now's a good time to be making smart acquisitions.
Yes. If you can find sellers, now's a good time to be made. If you've got the capital and you can find people who are willing to sell because they have to sell, now's a great time. This has been the case in prior recessions as well. we've seen that this is a good time to do acquisitions. Unfortunately, the challenge often is people don't want to sell at these low prices. Right?
Yes.
So it's often only if you find a company that both, it fits your strategy, it fits your M&A strategy, and they need to sell. That's how you can, those are the best acquisitions, right? I remember the last, during the, 08-09 crisis, I had lots of clients that wanted to make acquisitions because the prices were low, but a lot of people just weren't willing to sell at those prices.
Yeah, it's about how long the pain is going to last.
Yeah.
And if it lasts long enough, sellers are going to come to the table, right?
Right. And we don't know how long it's going to last.
Yeah, you have to be smart, keep some ammunition behind, and just, if you've got a well-funded balance sheet, this could be a very good time for you if you're a CEO.
Yeah, but it's a good time to be, it's also a good opportunity to be proactive and develop relationships with those companies.
Yeah,
so that they don't, that they feel comfortable negotiating with you, want to work with you if they do run into difficulties and do decide to sell.
Yeah, that's a nice way of thinking about it. It's not just going off and making an acquisition, but it's about building a relationship so that when things become bad and there are many suitors at the table, they come to you first because of the meeting of minds.
Right. They know your culture. They know that you'll work together. They know you've got a common sort of set of goals and values and things like that. You'll be in a better position to win, and perhaps at a lower price than otherwise would be the case. And ideally, in the best cases, you actually avoid an auction.
Yes.
The surprising number of deals, there is no auction, right?
Yeah.
When there is, a strong relationship between the buyer and the seller.
Yeah, and that's an interesting way to think of, you mentioned earlier boards need to set up strategy teams and so on. But as companies also set up M&A teams, it's not just about the technical side of due diligence and the legal stuff. It's also about building the relationships and having a pipeline of relationships.
That's absolutely important, and that's where a lot of companies get it wrong. They don't build those relationships.
And then they have to pay a lot more later to seal the deal.
Right. And you have to be patient, right?
Yeah.
You have to build relationships over a period of years.
Yeah, exactly.
So that when someone is ready to sell, maybe it's a family-owned business or a division of another company, and it's time to sell. You're the logical person that they want to sell. They want to sell it to because you developed that relationship.
Fantastic. Thank you so much, Tim. I think we've run out of the time we've been allocated. I enjoyed the conversation immensely. I hope you did as well.
I did too. I thought this was great. You prompted great questions that I really, had a great. I don't know if you did a lot of preparation or not. It appeared as if you were sort of giving me all the kinds of things I like to talk about. So
I know you well, Tim. Thank you so much, Tim. I hope things are good in Connecticut. Which part of Connecticut do you live?
I live in a town called Weston, next to Westport.
Okay, that's a nice area. I've heard about it. I think the weather is getting better. So early days of spring, I hope you have a good day.
Thank you. Hope you do too. And thanks so much. Okay.
Thank you. I enjoyed it. Take care. Bye-bye.
Take care. Bye.
That's it for today's episode. I hope you enjoyed it as much as I enjoyed doing the episode. Finally, I want you to remember that the only way to get access to our special offers, the only way to get our special pricing, and the only way to get samples of our content is to join the list on firmsconsulting.com. It's the only way also to get access to our unique advanced content that we make available to insiders. So if you want to get a sneak peek of things, test it out, see what's in there, this is the place to go. And finally, I want to thank you again for making us one of the largest podcast channels around the world for careers and for the 2 million downloads and counting.